Good morning, everyone. Welcome to Business Mornings. Time to do business on this Friday. Friday business, we can say, start from the global space as usual, telling you that this morning oil prices extended gains and headed for a weekly increase as falling inventories of United States gasoline and distillate raised expectations of solid demand, while concerns over supply disruptions in Russia lent support to that. Look at the numbers. We see a 16-cent climb this morning on Brent. That's 0.2%, $76.74 a barrel. WTI has the same, but of course different in the value, $72.65 a barrel. That's the price. Both benchmarks are set for a gain of about 1% this week. U.S. crude oil stockpiles went up. Gasoline and distillate fell last week, and it's because of seasonal maintenance at refineries that led to lower processing and brought about that. Also, the peace talks between Russia and Ukraine, that's also up in driving factors. Ukrainian President Volodymyr Zelensky early in the week had engaged or enraged the United States and Russia moves to negotiate. Now he has said that the talks he had with U.S. envoy was fruitful, so it looks like sentiments are changing from the part of Ukraine, and we'll see what happens with the EU. Also, they are also a major part of that. U.S. Treasury Secretary Scott Bessent had said that Russia could win some relief from the United States sanctions based on its willingness to negotiate to end that war in Ukraine. And of course, we know that Russia is a major contributor. OPEC Plus, they are the plus there when it comes to oil supply globally. Still, Kazakhstan has pumped record high oil volumes despite damage on its main export routes via Russia. That, of course, will bring down price. And then we come to Nigeria, where the Federation Account Allocation Committee, FAAC, has delayed its February 2025 meeting. FAAC Secretary Ali Mohammed, in a statement, is saying that a new date would be communicated soon and members will be informed of further development. This is the first delay in nearly 3 years since May 2022, when FAAC postponed its meeting following the suspension of the Accountant General of the Federation over an alleged 80 billion naira fraud. And there's so many stories going around concerning that, but not confirmed channels would not bring that to you. Now, Nigeria's insurance industry, we've been hearing a whole lot from that industry, even seeing the movement. Investor sentiment seem to be positive concerning it. What it does seem that they're getting even more attention now. The Financial Institutions Training Center, they've created a forum and are sharing a report on their findings as to projections, forecasts, and areas that could boost adoption of insurance in Nigeria. The insurance industry has been in the news in recent times, from the renewed commitment to enforce the third-party policy for vehicle owners to the Committee of the House of Representatives considering comprehensive reform of the sector. Building on this, the Financial Institutions Training Center, FITC, has created a forum to empower stakeholders with more information to meet up with existing and emerging demand through its industry report.
This report underscores the critical role of leadership and collaboration. And collaboration in the sense that Financial Institution Training Center, as you are aware, is a heritage organization that is set up to provide the entire players within the financial service sector with knowledge solutions that will advance the practices and the operators and all of the interventions that they make within the market space. Oftentimes, there is a divide with insurance between the operators as well as the regulators and the consumers. Many leverage insurance for when it is compulsory and mandatory. For a third party, for vehicle owners, people are thinking, oh, I do not want police to catch me, so they get their insurance done, so they get out of trouble. But it's much more than that. Insurance gives you safety, and that's the reason why it's important.
While the report highlights growth over the years, it also advocates more adoption of technology.
To bridge the identified gaps, we must adopt technological innovations such as InsurTech and RegTech, which have enabled top-performing insurance markets to optimize their operations. enhance customer experience, and unlock advanced analytics. NICON's strategic plan prioritizes strengthening regulatory framework and driving digital transformation.
The report captures the optimism of chief executives in the industry, but highlights areas lacking progress, such as customer education as well as technology. It calls for upskilling initiatives and aligning regulations with industry needs for sustained growth. Now, the Nigerian Communications Commission, the NCC, is making good its promise to increase technology adoption through Universal Service Provision Fund. Its latest effort is a new information and communication technology project in Ogun State Institute of Technology, Ogitek in Ibesa, in that state. The project, named Emerging Technology Center, sited on the Institute's campus, is aimed at enhancing learning experience of students while providing a platform for digital innovation, research, and development for the overall economic growth of Nigeria. The event was also a signing of a landmark memorandum of understanding aimed at ensuring effective utilization and sustainability of the ICT project in the Institute. And it is one of the access projects of the USPF, and a significant milestone towards the government's policy direction to bridge digital divide and promote digital inclusion across Nigeria. Now, yesterday was decision day for Nigeria. The CBN's MPC concluded its meeting for February, and of course we had the decision. It was a whole decision. Let's give you a little bit of what happened there. Of course, we had the studio open all through, and then we'll delve into perhaps understanding the mind of the MPC and how they arrived at the hold status.
Retain the MPR at 27.50%.
In line with expectations, the Monetary Policy Committee of the Central Bank of Nigeria has adopted a hold stance at the 299th meeting. The decision, according to the CBN governor, was unanimous to the 12 members of the committee after considering macroeconomic developments, top on the list being inflation, which was recently rebased to reflect an over 10% drop in the consumer price index.
Nobody should infer that inflation has fallen to that level. No, because you are really comparing apples and oranges. But suffice to say, though, because this is very important, that we can see that inflation is gradually trending down.
The perspective of the meeting seems to resonate with some economists.
I think the best way we can really assess whether the policies that they continue to implement are generating the desired outcome, especially when it comes to price stabilization, is to see whether there's going to be a continuous downward trend post-rebasing. Because if we see an upward trend, then you were just bailed out temporarily by rebasing, but the problem still continues.
The MPC believes that sustenance of the positive trend would depend largely on the collaboration between fiscal and monetary authorities.
It's one thing to come here, cut the rate, but that thing is to feed through. So right now, we're having, should I say, food issues, and it's not something that is for the central bank to do. They need the fiscal authorities to also, come to the party.
The next meeting is scheduled for May 19 and 20, 2025. Let's elaborate on that report now with the Acting Director, Monetary Policy Department of the Central Bank of Nigeria, Dr. Ladibala Kefi, joins us from our Abuja studio. Dr. Kefi, good morning and welcome to the program.
Good morning, Ini.
All right, so we saw there, a lot of people would have thought that the whole decision of the MPC was because of the rebased number, but obviously the Governor Cardoso there has said that they're still studying, the CBN is still studying the numbers, and that, it cannot obviously be or mean that inflation has dropped by over 10%. So what would you say is a major, or are the major factors that the MPC considered to reach a hold position?
Okay, thank you very much for this question. Yes, the MPC made their decisions based on data available to them, and this data covers all sectors of the economy: the monetary sector, the fiscal sector, the external sector, and all the sectors of the economy. And based on that, they took a decision. And let me quickly dive down into your question in in a specific manner. In November, already we had started seeing a deceleration. For example, headline inflation in November, between November and December, headline inflation decelerated to 34.8%, decelerated to 34.6% from 34.8%. In addition, food inflation decreased from 39.93% in November to 39.84% in December. Core inflation also decelerated from 28.75% in November to 29. Sorry, it was only core inflation that inched up a bit. So having said this, let me quickly just say that we hiked policy rates 875 times in 2024. And the reason was largely attributed to the huge excess liquidity in the system, largely due to the ways and means. When this new management came on board, there was huge excess liquidity in the system. And this excess liquidity was now adding to the inflationary pressures in the economy. And as a result, there was need to keep an eye on inflation. And the only way that the monetary authorities could do that was to deploy their tools, the tools that are available to them. And we used those tools to try and rein in inflation. And from the time that you make a policy to the time that you see the impact, there's usually a lag period. Sometimes it's 3 months, sometimes 6 months, but from the studies conducted in the central bank, it could take up to 150 days. And having done some hikes in 2024, it's now time, the MPC now felt it was time for them to take a back seat and just watch the impact of the actions that they had taken previously, to see how the economy will unfold in 2025. And from the numbers that I just read out to you, we had seen slight deceleration in December, as well as we've seen also an increase in the inflows into the external reserves, largely due to the aggressive drive for inflows, especially diaspora remittances by the management of the bank, and also some reforms that the bank had instituted in order to stabilize the Naira, the dollar, the Naira, vis-a-vis the other foreign currencies, especially the dollar. And it must be understood that the dollar exchange rate has a pass-through to inflation, most especially in imported food. So once you get your exchange rate right, for us in Nigeria, it will also largely address food inflation. So we've seen some gains over the period from last year to this year, both from the monetary authorities as well as the fiscal authorities. The fiscal authorities on their side, they have embarked on large importation of food to support the demand of food in the economy, and also insecurity in food producing areas has largely has relatively been addressed. So farmers can now go to the farm, and farm produce, inflation on farm produce decelerated also. So with all these gains that we had been seeing, the MPC looked at all these numbers because, as I said earlier, decisions are taken based on empirical evidence and data available to the MPC members. And then they took a decision that, okay, let's hold. And when you hold, it doesn't mean that you're being bearish or that you are loosening. So holding could also be tightening because already we were on that upward trajectory. So it's time for us to take a back seat because we did implement some policies recently in the Central Bank of Nigeria, like the electronic foreign exchange match system, which is popularly called the B-match system, and also the Nigerian Foreign Exchange Code, which was launched last month, largely to institute governance, transparency, and ethics into the foreign exchange market, just with the specific objective of addressing Naira volatility and also to stabilize the foreign exchange market in order to curb inflation. So with all these policies that the bank had instituted, in addition to the capitalization of banks, which we are hoping should be concluded soon, because we are at the process of verification of capital. Once that is done, we know that the situation in inflation will decelerate further. And that was the reason why the MPC took these decisions. And I must add also quickly that we've seen that there are surveys conducted usually by the Statistics Department of the Central Bank of Nigeria. And from the survey, we've seen sentiments of consumers and firms. For example, last year, largely, the sentiments by households showed that they were not too comfortable with the economy and they didn't believe the inflation would come down. However, the recent survey that was conducted showed that the percentage of citizens that had that pessimistic sentiments had decreased. But for the firms, they've always been consistent. The firms have always believed in the policies churned out by the Central Bank of Nigeria. They believe in the policies of the that are made at the MPC. They've always had optimistic view that inflation will decelerate and that the MPC decisions will eventually stabilize the economic environment for them to thrive. And that's why largely we can attribute this to the reasons why the MPC decided to hold. In addition to also the participation in the equity side of the market, for example, all share index increased by 9.30%, as well as market capitalization by 12.49%. So all these are indications that the economy is picking up, that the monetary policy transmission mechanism to these other sectors are having a positive impact. We've also seen that in the balance of payment position, current account position of the economy, as we gained a surplus of over $6 billion in this period. So we've seen also industry sector PMI expanding. So all these are signs that the economy is picking up. And if you are a player in the bond market or in the securities market generally, you would notice that Nigeria's 10-year turnout bond was oversubscribed. So all these are positive signs of the decisions are having impact, the desired impact.
All right, Dr. Kefi.
What the fiscal authorities are doing.
All right, Dr. Kefi. Thank you for that elaborate explanation as to how the MPC arrived at its decision. But of course, we see the numbers also, and we hear the optimism, the pessimism, that meets. One of that is we have seen a stability of some sorts in the value of the Naira for some months now. We've seen it hovering below 1,600. In fact, 2 days ago, we saw a major leap at the parallel market, which of course brings joy to the hearts of a lot of Nigerians. But there's still the fear that this is just a short stay and we may soon see the Naira drop again. So being in the monetary policy of the CBN, could you give us that confidence as to the fact that we would see a fair value of the Naira and better still, stability in the value of the Naira?
Okay, that's a very good and valid question. As I mentioned earlier, the governor of the Central Bank of Nigeria is determined to bring sanity to the foreign exchange market. Because before he took over, there was chaos in that market. And for 4 years, we didn't have inflows into the economy. But now, there is transparency in the way the market operates, in addition to the measures that have been put in place. For example, investors were looking for investors to come in and invest in the economy. What we're looking for mostly are foreign direct investments, but if we're also interested in foreign portfolio inflows. If we get both, the economy will be sound. And that's been the focus of the management of the Central Bank of Nigeria in the last 1 year. And there's been an aggressive drive towards attracting diaspora remittances. We've gone on road shows internationally to attract Nigerians living abroad, to assure them that the economy is safe and sound for them to remit their earnings into the financial sector legitimately and reduce informal remittances. And also to assure them that they can invest in businesses in Nigeria. And in that vein, in last year alone, we have gotten over $4 billion into the economy from remittance inflows. And that's because there's been transparency in that space, as well as credibility of the governor in particular, who people believe with his team that they will put word to what they say. They will put action to their words. And I'll tell you quickly that the overall balance of payments position, as I said earlier, recorded a surplus of over 4 billion, which specifically 4.21 billion, compared with a surplus of 2.47 billion in Q2 2024. And as at end January, the reserves stood at 38.71 billion. And last year, we got up to over 40 billion. And a monthly average of inflows has not been less than 600 million. So this shows you that there's a sustainability trajectory in that space. In addition to what I mentioned earlier, the measures that the bank has put in place, such as the B-match system, which I had mentioned earlier, which was introduced largely to bring governance, compliance, governance, credibility, ethics, and transparency into the foreign exchange market, as well as the Nigerian Foreign Exchange Code. These are international best practices, which once investors see that you have these things in place, it attracts them to your economy. And trust me, in the central bank, these things are adhered to strictly, and Governor Olayemi Cardoso has made pronouncements that should any bank default or be seen to be going back to the old ways, that they will be addressed immediately and there will be sanctions. In view of that, when they know that when you make a statement, you do it and you stick to it, they will fall in line. And I'm sure if you've been you're in the media space, so you must know what the central bank has been doing lately with regards to compliance. He has been actually addressing banks that are errant. So be rest assured that with this in place, there will be sustainability as well as moderation in that FX and foreign exchange stability. In addition, we are also collaborating with the fiscal authorities. We had a monetary policy forum on the 30th of January, which saw a number of ministers from the fiscal side attending, and the forum was largely to enable them discuss on various ways in which to strengthen the economy and strengthening that economy to project growth, as well as ensure that economic activities thrive. And for that, the central bank is not the only agency that is responsible to address that. We know that, and that was why that forum was held, in order to open conversations with these other agencies. The Minister of Finance, the coordinating Minister of the Economy, was there, with the Minister of State, the Minister of National Planning was there, the Minister of Trade was there. Mind you, the governor is the champion for the African Continental Free Trade Area for the financial sector, and we take that role very seriously in the central bank. Currently, we're trying to see how we will support trade and investment, to boost investment, because when investment thrives, we get inflows, it will lead to accretion to the reserves. So we are on all fours aggressively trying to ensure that all these things are put in place. At that forum, we had Manufacturers Association, we had NASIMA, we had the president of the Bureau de Change, we had also in attendance the academia. It was a forum whereby everybody said what they felt the CBN was doing rightly or wrongly, and they also preferred solutions. And the governor took attention. He listened carefully, took notes, and addressed the audience and said, look, I've heard you, and we're going to address all your issues. And more of these forums will be held, so that we'll have a constructive line of engagement with our stakeholders. So with all these measures on ground, in addition to what the fiscal side is doing, all these investment drives that the central bank has been undertaking, some are also with the fiscal authorities. The governor of the central bank just returned from Saudi Arabia with the Minister of Finance and coordinating Minister of the Economy. They participated in an IMF inaugural conference of emerging markets economies. Now Nigeria is now playing in the global space. For some years, Nigeria wasn't invited. And now Nigeria is invited, and that enables us to tell our story, to tell the world what we are doing, the reforms that we are doing, and then give them data. Data speaks for itself. When you see the data, you see that what they are saying on stage is actually what is happening on ground. And the governor mentioned it at the MPC. A couple of days ago, some investors came in from Saudi Arabia, just a day after they returned from the Emerging Market conference. Now we see the central bank governor taking a center stage, a global stand everywhere. He's been invited because people believe in his reforms.
All right.
When he took over with his deputies, the first thing they did, one of the first actions they did, was to ensure that you will be allowed to repatriate your surplus.
All right.
The backlog of foreign exchange, dollar, that was owed to investors were paid.
All right, Dr. Ladi.
The 41 items were unbanned.
All
so
right.
you can see that transparency has been introduced in the activities of the monetary authorities.
All right, Dr. Ladi Valakefi, thank you so much. I know you would have a whole lot to reel out, but I mean, we're just glad that at least we see signs of stability with the Naira, and as you said, the hold position does not necessarily mean that the central bank has turned dovish, but we'll be following it. And I know by May, the central bank will be looking at the numbers from the NBS to see what direction we would go next. Thank you so much, Acting Director, Monetary Policy Department of the Central Bank of Nigeria, for your time and your views this morning.
Thank you for having us, Ini. And I hope that we have been able to convince the Nigerian citizens that Nigeria is ready for business, and the central bank monetary management, as well as the MPC members, are determined to rein in inflation at all costs, and whatever it takes for them to rein in inflation and boost economic activities in the economy, they will do it.
All right, thank you so much. At all costs actually is scary, you know, because the real sector also suffers it at some cost. But thank you so much for telling us the determination of the Central Bank of Nigeria. Now let's take a break. When we come back, we're still on the MPC decision from yesterday. That was from the CBN. Let's hear from the private sector and possible impact of this whole position or expectations in the coming days. But let's pay some bills. We'll be back. We're still watching Business Morning, and yes, we are still on that February decision from the MPC. Now we have the Group Chief Executive Officer of Cowrie Asset Management Limited, Mr. Johnson Chukwu, joining us to share his thoughts on this. Mr. Chukwu, good morning and welcome to the program.
Good morning, Ini, and thank you for having me.
Yeah, so we just had an elaborate conversation with Acting Director from the CBN, warning us that we shouldn't get excited about the hold stance, because it could also come out as being hawkish. But what's your perception about this whole stand of the MPC?
Interestingly, I had actually predicted that the position of the central bank should be hold. Principally because if you look at the macroeconomic environment, both that looking at the local environment and the global environment, there are too many uncertainties that a rational policy decision would be to wait and see development in the direction they will go. Because you don't want to take decisions today that you have to reverse in the next few months, or you regret that you took that decision. Take, for instance, looking at the local economy. Of course, we saw inflation at 24.48% in February. And like the CBN governor said, we shouldn't make the mistake of comparing this to 2024 inflation figure, because the inflation figure for January 2025 was based on an elevated base and was based on average prices for last year. So you're no longer doing what was the average price in January compared to January 2024 compared to average price in January 2025. You're now looking at what was the average price in the entire year. And if you cast your mind back, the inflation rate got as high as 34.9% before we got down to 34.8%. So it then means that the average inflation that we had last year would be in the region of 30%. So when we are talking of an increase, which what I'm just trying to emphasize, that the increase, the inflation pressure is still quite steep, because at 24% or average 25% inflation figure on a high base is still very high. So there is still a need for the central bank to take a policy decision that will ensure that the inflation rate does not worsen. Two, you look at exchange rate. We've seen some respite at the exchange rate level. But then what should also go with the exchange rate? Are we seeing a higher level of productivity? We saw a GDP growth rate in third quarter of last year about 3.46%. But that GDP growth rate was very fragile, because the major contributors to the economy were growing at a very weak rate. Agriculture, which accounted for 28% of the GDP, grew at only 1.14%. Then the next one is telecommunications sector, which of course accounts for about 16% of the GDP, but grew at about 5%. And then followed by trade, which accounts for 15% of the GDP, grew by 0.6%. Then followed by manufacturing, about 8.4% of the GDP, grew by only 0.1%. So if you look at the growth rate in these sectors, it's still very weak. So if you take out the telecommunications and the other sector that are big, account for up to 10% of the GDP, we are growing at very anemic rate. So you can't say your economy is actually rebounding as to actually now say I can actually go ahead and tighten, because this is what we say, look, I'm only fighting inflation, the economy is growing, so let me tighten to bring down inflation. Then you also look at the global economy. You look at the uncertainties around the price of crude oil. because of the policy of Donald Trump. You have uncertainty about the global trade and demand even for input materials, about the nationalistic protectionist policy of Donald Trump. So these are factors that will eventually have to settle and define their impact on the global economy. And that's when the central bank will be the most appropriate position to take a definitive decision on either tighten further or loosen. And so if you are in a position where you are uncertain whether to tighten further or loosen, the most appropriate thing becomes to hold, and which is what the Central Bank Monetary Policy Committee did.
It sounds like you see a hold. I mean, I know there was a period when it was almost predictable that every time the MPC met, it would be a hold position. Do you see us getting back to that era?
No, I don't think so. We are dealing with a current central bank governor that is very active. We are dealing with a monetary policy committee that is very definitive and decisive in their position. Even at periods when people like I and a number of people say, look, further tightening was weakening the real sector of the economy, and that the inflationary pressure we are facing was not driven by excess liquidity or excess credit, that we should not continue to tighten. The central bank governor was still determined to tighten. So I do not think we can now begin to speculate that the central bank the outlook will always be hold going forward. I think if they see further inflationary pressure, because the inflationary pressures, the downside risk about on inflation in the country is still there. The federal government has come up with a very expansionary fiscal plan of 54.9 trillion naira and planning to raise only about 14 trillion naira with a projected deficit about 13 trillion. But we know that even that projected deficit is actually understated or very optimistic, because we know that the revenue projections are not realistic. So that means there will be a lot of liquidity injection coming from the fiscal authorities. Even the budget is fully signed into law and they begin disbursing funds, we could see inflationary pressure come back. And remember that the next MPC meeting is May. So there could be a lot of liquidity surplus that will compel the Monetary Policy Committee to now tighten, to suck out that liquidity from the economy. So I can't at this point begin to say that we should begin to expect that going forward they behold. There could also be compelling reasons. If inflation rate comes down materially, probably because of the drop in crude price and drop in pump price of fuel and some other, and then strengthening of the local currency. These two factors have the upside potential of bringing down inflationary pressures. If the local currency strengthens because of increased crude production, because of lower crude prices, and then you also have a lower inflation rate, or maybe there's improved food production. So the monetary authority can actually take a decision. Let's now focus on economic growth, and therefore they will decide to loosen, to allow liquidity to flow into the economy at lower cost and allow for more productive activities.
So I mean, I personally was happy when the central bank governor, and reiterated by the acting director, was on the show about the collaboration between the fiscal and the monetary authorities, because everybody now knows that the central bank does have its limits, you know, as to the policies they can engage in to tame inflation. But are you happy with the level of collaboration between the fiscal and the monetary authorities in this drive to tame inflation in the economy?
No, for me, it's not a matter of whether I'm happy. It's a matter of doing the right thing. Of course, we are coming from an era where there was a very significant fiscal doldrum, where the fiscal authorities under the President Muhammadu Buhari's era was almost non-existent or was not active in discharging their duties, which compelled the monetary authority to go into an overdrive to begin to do the works of the fiscal authorities and the monetary authorities. So we had a kind of a convoluted monetary policy environment where a lot of the monetary policy actions were more of what should have ordinarily been described as fiscal decisions. But now we have some reasonable level of active fiscal and monetary regime. So in that, given the level of activeness of both arms of economic management, one would say that it's a material improvement in the engagement, in the discussions, in the understanding of what should be priorities to the government. But the conflicts are still there. I don't think the conflicts have been completely eradicated. I have just made allusion to the fact that the fiscal authority has enunciated or pronounced a very expansionary fiscal plan, and that fiscal plan will create liquidity suffix into the economy, which will put pressure on prices. And the Monetary Authority have always said repeatedly that their primary objective is price stability, and they will focus on price stability. So at the time when the Monetary Authority is focusing on price stability and the Fiscal Authority is focused on economic growth, then you can still see that there has to be further harmonization of the primary and overriding objective. And my approach has always been the most overriding objective is create a productive economy, and then that will bring down inflation in the medium to long term. But what I'm saying in the fact that a 54.9 trillion naira budget that is laden with deficit higher than even the projected 13 trillion deficit will counterbalance some of the measures that the Monetary Authority is taking to stabilize price levels. So that means we still don't have a perfect harmony in terms of policy harmonization.
But I do hope that at least we are heading that way. What about the area of FX management? We've seen a lot of policies and efforts from the central bank, the issue of remittances and all. Do you think we're on a comfortable track to a stable Naira, or do you think more needs to be done?
Well, in the short term, one would say that the policies as at today will drive some level of stability in the exchange rate and possible improvement in the exchange rates. But there are also other factors that may unravel that directional movement or may vitiate the further strengthening of the Naira. One is actually global environment. I had mentioned the fact that crude prices are likely going to decline because of Trump's decisions and policies. So if we do not produce more crude, of course, the report I saw said we are producing about 1.7 million barrels of crude and condensate. If we don't continue to ratchet up crude production and crude prices drop, it could put a lot of pressure on our foreign earnings, a lot of pressure on reserve that could reverse the gains we've made in exchange rate appreciation. Then what could central bank do? The central bank could reverse the current declining yield on treasury bills, which I think the director of financial service or policy, monetary policy that you just finished interviewing had made allusion to. So if this, we saw a treasury bills auction on Wednesday, the 19th of February, with a stop rate for the 364-day bill at 18.43%. That's a material decline from the region of 22.8% we saw in November last year. Even this year, we've seen about 20% auction stop rate. And we also saw a decline in all the tenor buckets. The 91-day bill had a stop rate of 17%, and then the 182-day bill had a stop rate of 18%. These are instruments that 182-day instrument had been maintained a stop rate of about 18.5% for quite some time. So over 50 basis point cut off from that stop rate. So we've seen the central bank now borrowing at a reduced interest rate. But if what I had mentioned earlier, reserve begin to come under pressure because of lower crude production or lower crude prices, then the central bank, for it to sustain Naira appreciation, Naira stability, will have to offer these bills at much higher rate to sustain the interest of foreign portfolio investors. So it depends on how swiftly the central bank read macroeconomic outlook and take decisive actions or directional actions that will guide the response of economic agents in either patronizing our instruments or selling down our instruments, in either bringing capital inflow into the economy or having capital outflow from the economy.
All right. Well, it does seem that you cannot win everything. So if you have your inflation tapering and your interest rates reducing, then the stop rates will also reduce, and that could also affect your FPI. I guess that's the reality of life, Mr. Johnson Chukwu. Thank you so much for your time and your views this morning. Chief CEO of Cowrie Asset Management Limited, Mr. Johnson Chukwu.
Thank you for having me.
All right, Mr. Chukwu was just talking about the markets there, fixed income market. We've seen the reduction in yield rates in the last two sessions, one OMO and one NTB, and the fear of losing out on FPI seems to be getting more real with stability in the interest rates. You know, that's just how it is. But let's see how the market closed. That's the NGX, the stock market, domestic stock market closed yesterday. It closed in the negative 0.04% at 108,568.57. The market cap is still around 67 trillion. Naira activity was mostly green for yesterday. Just value dropped to close at 8.42 billion naira. Top gainers, Abe Buildings. Out of nowhere, we're seeing, you know, some of those stocks. That's the building, UPL and Sovereign Insurance. You know, there was that report from FITC, Sims Insurance. They are keeping the attention, even though not very big attention, talking about insurance stocks, but they are still there. Top losers yesterday, Union Dicon and DCAP and CW, and top trades were Elalix, Zenith Bank found its way there, as well as GTCO. I guess the financial sector, or more like the banking counter, will always find its way into the news. Now let's see the unlisted market, OTC market there. It was positive at the close of trade yesterday, 0.51%, 3,262.52. That was the share index. Market cap 1.85. Slowly and surely, they'll seem this market is growing. Remember when it was less than $1 trillion? Now they're heading to $2 trillion. So if it's not too late, some investors will still want to go in. The activity chart for that market yesterday was red, 17,000 for volume, value 1.26, down more than 80% for both deals, 71.43% in the red. Only 6 deals. Stock traded also lost more than 44% at the close of trade yesterday. Well, that's the market, but let's do a bit of international global news before we head out here. We start from the United Kingdom, where retail sales grew more strongly than expected at the start of the year. Robust demand for food offset weaker consumer confidence. The volume of goods sold online and in stores increased by 1.7% in January, partly raising a revised 0.6% loss recorded during the crucial festive season in December. The Office for National Statistics said that this was the largest increase since May. Economists had been expecting about 0.5% gain. The January boost was largely driven by food sales, which experienced a notable 5.6% rise in sales volumes, and this makes the largest month increase for food stores since March 2020, suggesting that more consumers are opting to dine in after the festive period. However, sales in non-food sectors, which include clothing, household goods, showed a dip of 1.3% over the same period, reflecting ongoing challenges in consumer confidence. Despite this, overall retail performance was a positive sign for the sector, with online sales showing a slight recovery, up 2.4% in January compared to the previous month. UNS data highlights a shift in consumer spending habits as the proportion of sales made online fell to 25.7% from 26.9% in December, signaling a return to physical store shopping. For the wider retail sector, a 1.7% rise in sales volume in January is a welcome sign after a series of declines in the final month of 2024. Now, Amazon App Store for Android will be off from August 20. The company has officially announced that starting on the day, you will no longer have access to it on your Android phone device. It's unclear what exactly will happen. Will the app simply stop working, or will it throw a notice that the app is discontinued, or will it just disappear from your device? We'll wait for August 20 to see that Amazon is also killing the Amazon Coins program on the same day. So if you have any, you need to use them before August 20 because Amazon Coins will no longer be available for purchase. And well, I don't know those either, what will happen, but they are no longer available they will no longer be available from August 20. If you have some coins in your account, you might want to use it now so you don't totally lose out of it. Well, that's coming from Amazon App Store there. Now we go to Japan. Japan's inflation is out and it climbs to a 2-year high of 4% in January, hitting its highest level since January 2023, further strengthening the case for the rate hikes by the country's central bank. The core inflation rate, which excludes prices for fresh food, rose 3.2% from 3% in the prior month. That beat expectations of 3.1%, and then this figure was the highest since June 2023. The core inflation rate, which strips out prices of both fresh food and energy, is closely monitored by the bank. That's the Bank of Japan. It climbed slightly to 2.5% from 2.4% in the previous month. The headline inflation rate, which had come in at 3.6% in December, remained above the bank's expectation of 2% target for 34 straight months now. Immediately after the data was released, the yen threatened at 0.15% to trade at 149.39 against the dollar. The inflation figures boost the case for hikes by the BOJ, with deliberated tightening them at a January meeting, with its summary of opinions warning that inflation risk and weakness in the yen. Yields on 10-year Japanese government bonds, which had scaled the 15-year high of 1.447 in the previous session on rate hike expectations, fell to 1.4 after having risen for the past 4 days. The CPI data comes after the country's GDP growth beat expectation on a quarter-on-quarter and annualized basis, rising 0.7% and 2.8% respectively. However, full-year GDP growth for 2024 slowed to 0.1%, a sharp fall from 1.5% growth seen in 2023. DeepSeek is back in the news. The sudden splash in the large language model space has given China a powerful tool to catalyze artificial intelligence adoption in the country and also boost economic growth. While Goldman Sachs pegs a 20 basis point to 30 basis point boost to China's GDP over the long term by 2030, it expects the country's economy to start reflecting the positive impact of AI adoption from next year itself, as AI-driven automation improves productivity. The enthusiasm around DeepSeek is also being reflected in the sharp rally in China's stocks, with the MSCI China index soaring over 21% from its January low. And then the startups' rise is triggering a reassessment of China's investability after an extended period of limited attention. This is according to Morgan Stanley. The company's launch of a cheaper and more efficient AI model came as a timely confidence boost as the Chinese leadership faces a prolonged economic gloom, partly owed to the slump in the property market, while the specter of a fierce trade war with the US looms very, very large. Now, staying around that, Chinese technology stocks jumped the most in 3 years, boosting equities across Asia after optimism toward the sector got a boost from earnings of Alibaba Group Holding Limited. The yen weakened back past 150 for a dollar. A gauge of Hong Kong's listed tech shares advanced as Alibaba surged almost 14% on the back of its earnings. The regional index rose and is set for a 6-weekly gain, the longest winning streak in almost 1 year. And the yen slipped after the Bank of Japan Governor Kazuo Uda signaled its readiness to quell a surge in bond yields, and European and US equity index also edged marginally lower. And also going to what's happening with Emirates now. We hear that the Emirates is interested in pharmaceutical cargo. They get a premium, that's the pharmaceutical cargo. They get a premium attention from Emirates. That's one that they say it's one of their focus to ensure that pharmaceutical cargo gets premium priority and get to their destinations as made without any form of interruption or damage. And this was made known by the Divisional Vice President of Emirates Sky Cargo on the second day of the Air Cargo and Transportation Logistics Africa Conference, where over 4,000 aviation stakeholders from 150 countries converged to discuss cargo in the aviation industry. At the event in Nairobi, Kenya's capital, Abba states that considering the importance of pharmaceutical cargo because it deals with human health, the airline always places top priorities on cargo of such nature and always ensures that it is delivered as received. To prove the airline's seriousness on health-related cargo, the airline boss said Emirates has invested in 15,000 square meters of GDP-certified facilities in Dubai, a facility that he adjourns as the largest and most advanced globally. And with that, we come to the end of the program for today. But you know that you can always watch this program. Go back to our YouTube channel, and then you would watch the program at any time. But if you don't want to do that, you can get a fresh episode of Business Incorporated. That's coming in just over an hour or so. That's at 1 p.m. I'll be back, take you around the world of business in 55 minutes. Until then, get some coffee, make some money. I'll see you at 1.